Welcome. Very important data on the economic front released right now, and you are seeing it flashing on your screen. The CPI inflation in the month of April has come in at 7.79%. This is a bit of a shocker. It is at an 8-year high, and it is significantly beyond the comfort zone of the Monetary Policy Committee of the Reserve Bank of India. The IIP for the month of March has come in at 1.9%. To understand the implications of this, both on you and me as well as on the course of monetary policy, I'm joined by Maithili Busnurmat, who is a consulting editor at ET Now, and Aditi Nayar, who is a chief economist at ICRA. Thank you so much for taking the time, Aditi. Maithili, I'll hand it over to you. I guess this lends credence to the out-of-cycle policy meet that was taken up.
Well, it also lends credence to many other things that perhaps of RBI's errors of both omission as well as commission. Because as you said, this is a CPI of 7.8%, the highest since 2014. In March, we were talking about 17-month high, 18-month high, and now we're talking about an 8-year high. So it's certainly not good news, and particularly when one feels that perhaps some of this could have been avoided. But I do not know whether Aditi shares my views about, whether this 7.8% was something that is not entirely because of extraneous circumstances, because we also have food inflation at 8.36%, we will also have a core of 7%. So Aditi, could some of this at least have been mitigated? Have the RBI acted a little earlier? Aditi.
Sure, Maithili. We had forecast the CPI inflation for April at 7.4%. It's come in 40 basis points higher than our forecast, and that I must say it's resoundingly higher than what we had expected. Food and beverages is actually very much in line. So the negative surprise is not coming in from food and beverages. It's coming in from a whole host of other items. One is fuel and light, one is clothing and footwear, and one is miscellaneous. And between these three, we've got actually a very large chunk of the CPI inflation basket that we're covering. So I think, not only is the number higher than expected, but I'm afraid we're now looking at more of a generalization of the inflationary pressure. And that is definitely something that we must pause and think about in terms of what it means for the trajectory going ahead. Now, could it have been preempted? Could we have done an earlier rate hike? Let's just sort of, break it down into what has really led to the recent spike since March, which is the geopolitical tensions. So, as early as February, we didn't know that we were going to get into the situation. So, it's been a couple of months for sure. But really between February and the off-cycle policy meeting in May, there was only the April policy to have been able to react to the fact that the geopolitical tensions had played up as they had. And I must say, in hindsight, sitting in April, even I wouldn't have imagined that things would continue, that the conflict would be as protracted as what it's turned out to be. So I think I would like to say that with the benefit of hindsight, we may think that the RBI could have acted a little sooner, but I don't think that it's fair to say that in April they would have envisioned such a protracted conflict.
Well, Aditi, I certainly buy your argument that nobody expected the conflict to continue for so long. But the fact is that we've been living with excess liquidity of 8 lakh crores for close to 2 years. We also have core inflation that is stripping out both fuel as well as food at 7%. Now, if you remove the fuel effect and if you remove the food effect, you still have 7%. Then clearly that points to things beyond Ukraine. So my position clearly is just this, that ultimately was excess liquidity allowed to continue for far too long? Because even though you've had an out-of-cycle hike, it is a fact that monetary policy acts after a lag of at least 3 to 4 quarters. So are we condemned to live with 8% inflation for the next 3 to 4 quarters?
So, I'll still argue that global excess liquidity and high commodity prices have had a role to play in our core inflation being as high as it is. Again, I'm going to go back and say that if we were looking at the inflation projection in January, February, it wasn't this high because we didn't expect that the companies would be forced to take the kind of price hikes that they've had to because of the way that multiple input prices have jumped. So it's very unfortunate. It is a combination of all these factors, and I still will hold out and say that not everything that is pushing up inflation can, in our domestic circumstances, can be controlled by monetary policy actions. So I'm not sure that this is going to be it is going to end up being a blunt tool in any case, and the sooner we started, I'm in hindsight, of course, the off-cycle policy meeting is very efficient. It's good that the rate hike cycle was started when it was, and I think now, of course, there's a very high likelihood that we're going to get a back-to-back rate hike in June as well.
One factor that we haven't talked about, but which has an important impact on inflation, is rupee depreciation. We've seen the rupee depreciate very sharply, and we've seen that though RBI has been intervening, it really has been able to kind of reverse the tide. How much of a problem will this create in terms of inflation? Because we've seen there are estimates about how 5% depreciation after so much by way of inflation, etc. So how much of inflationary pressure will be contributed by rupee depreciation?
So that I think will be a factor that we need to contend with more in the month of May. Certainly this is going to be something that is going to prevent the CPI inflation from coming off very sharply, although we do expect that high base is going to at least, I'm hoping that the April number is going to be a peak and that after that a base effect is at least going to pull down the number. But I will still expect the May number to be somewhere in the range of 6.5 to 7%. While it's going to be softer, it's still going to be very ugly, and I do think we're in for 3 to 4 quarters perhaps of inflation remaining uncomfortably above the 6% mark until the conflict ends and commodity prices then suddenly correct by, let's say, 10 to 20%. When that will happen is extremely difficult to gauge at this point in time, but that is really going to be the inflection point as far as the inflation trajectory is concerned. Even if we have a good monsoon, I do fear that we're not going to be able to control the kind of items in which inflation is very high right now. So that's also going to be a little bit of an issue going ahead. So hopefully the monsoon will be normal, so at least there are not going to be additional pressures that are going to get created from that side for the food basket. But the edible oils as well as all the other items related to poultry and feedstock that are very high, this is again something that is going to remain an issue until the supply side doesn't ease out. And vegetables, of course, with the very quick onset of the summer and the very high temperatures as well as the increase in the diesel prices, that has also led to a problem. Not sure that that's going to resolve within a month or two. Typically, when vegetable prices go up, they tend to be a little bit sticky for a few months. So this again would be an upside factor as far as the May number is concerned.
Yes, you're right. As far as vegetable prices are concerned, the summer months we always see vegetable prices rise, and this year we've seen an early onslaught of summer. So vegetable prices are likely to go even higher. So when the RBI MPC meets in June, do you think they will this is really an open question, will they try to correct for past errors by making a 50 basis point hike, or will they kind of be a little more wary given the fact that government is clearly unhappy with the way yields are rising?
I think, this morning I thought we're in for 325 basis point rate hike. After seeing today's number, I would say that we probably get another 40 in the June policy, followed by 35 in the August policy, so that we reach 515 by the August policy. That, to my mind, seems to be the most likely course of action going ahead. 50 tends to alarm the market. We've already done 40. Another 40 would be less alarming at least. And it's still a fairly large magnitude.
Okay, so I just have one last question, Aditi, on the IIP. It's quite strange that now nobody's interested in the IIP anymore. Everybody's looking only at the inflation number. But a quick answer to how do you look at the IIP numbers?
The IIP is disappointed. I mean, we were looking at a number between 3 to 3.5%, and manufacturing is clearly what has undershot our expectations. When we look ahead to April, there's lots of base effects. Optically, the numbers are looking very good. So it's going to take a little bit of teasing out to understand what the outlook is looking like. More than half the high-frequency indicators that we track are above pre-COVID levels, even in April, despite what has happened in terms of the global uncertainty. So, maybe we need to sort of look a little ahead, moving on from the disappointing March IIP number.
Well, yes, I guess that's the only way to look ahead and think that we can move away from the disappointing numbers, both of IIP and more specifically of inflation, which hurts all of us. Thank you very much, Aditi, for joining us and helping us pass these numbers. But I'm afraid it's time for us to slip into a very short break. Thank you so much.